Welcome to the Perspectives on IBC series, where advisor Chris Tormey joins me in a discussion on all things related to the infinite banking concept. In this educational series, you'll learn the basics of IBC and how you can recapture the financing function in your life so you can gain more control and freedom of your wealth. So welcome back, Perennial Pride listeners. I'm here with Chris Tormey for part 5 of the Foundations of IBC, the Infinite Banking Concept. So Chris, thanks for joining me on this episode.
Tom, great to be here. Thank you.
Right. So we've covered a decent amount of ground. If you've been following this series, we're on part 5 already. Unbelievable. And the last episode, we touched on why did Nelson call it, right, infinite banking itself? So if you haven't listened to that, I urge you to go back. But today we're going to cover kind of a broader topic around the life insurance industry, right? There's a lot of information around it that, may not be 100% accurate. And, we want to share a little bit more about the truth of the life insurance industry so you have a better feel for it as you get into exploring IBC. So Chris, one of the things that we talk about, everyone thinks that life insurance companies are all kind of the same, right? It's a commodity. Well, we know that there's different varieties of how companies are structured. So do you want to kind of walk the listeners through the difference between, say, a mutual or stock company and give people understanding what that may mean for them?
Yeah, I'd love to, Tom. So that is the big difference in our minds, at least, is you've got one type of company that's a mutual, which means the ownership structure is with the policyholders. And then you've got a second type of insurance company, life insurance company, that is owned by the public. And so it's got a extra layer of responsibility, of income share, even of I think corporate guidance in many ways that is related to Wall Street and the public markets. And so as we hear a lot, driven by quarterly returns, pushing into new types of structures or new types of even investments in their investment portfolio, really driven by perhaps a shorter term kind of focus of returns for the shareholders, whereas mutual companies also want the returns. They want good returns, but they look at it more in the way of long term, signing with someone who's 25 or 30 years old, who they hope and believe will be with them for 20, 30, 40, 50, even 70 years when you're talking about someone in their 20s. And so there's a much more long-term view. And there's a lot more that goes to the policyholders because there's not that layer of corporate dividend that's part of the equation. So those are the two I see as the major differences, is the way they conduct, they drive the business model, and also how profits are shared between the two different types of firms.
Yeah, I think it's a really good distinction you made there, and I think it's important for listeners here who are considering IBC to recognize it, because the companies that are being used are mutual. So you are part owners of that company in that respect as an insured person and policy owner, and we get dividends, right, and profit from the company. And so it's a private company; it's not public, and so it may be a subtle difference, but in the end, I think it's a pretty sizable one, because we know as companies go public, and to your point, the pressures around that to report earnings and to give shareholder value, and sometimes you give up some long-term sort of progress and sort of growth for short term. Right, that's what ends up happening because you're trying to kind of meet these quarterly earnings. So that's why Nelson, in his infinite wisdom, said these are the mutual companies are the ones you use for this sort of purpose.
Yeah, Yeah, agreed. And there is overlap in the structures. There are public insurance companies that offer whole life insurance, that's for sure. And there are mutuals that offer the sort of permanent products that we're going to talk about, I think, today in our conversation, that are not part of the of IBC, at least in the mind of Nelson and the Nelson Nash Institute, but are permanent. They are permanent life products, at least in terms of, and that's worth, I think we've talked about once before, that's worth mentioning again. Unlike any other form of insurance, which is basically an expense unless or if an event occurs, life insurance is a when type conversation, not an if type conversation. Almost all other insurance is an if conversation. If a home burns down, if a car gets in an accident, if you become disabled, those are all ifs. Whereas for life insurance, certainly in the term life, if you pass away in the next 10 years or 20 years, but as we know, that's a very low probability if compared to permanent insurance, which is a when you pass away, because you're covered until you die, or until you lapse the policy, which is, we'll talk about as well today.
Yeah. And one thing before we move on from the mutual versus stock companies, there are some companies that started as mutual and then turned to stock companies, right? And we've seen some more recently, and this is why it's important. We operate with some of the largest companies that have a long history of being in this industry, like some of them well over 100 plus years. And so it's important to understand the types of companies there, even in the mutual space, right? As you're talking to your advisors about it.
Absolutely. Yeah. It's interesting, since being in this practice, my sense of years and decades and generations has changed. I mean, many of these mutuals have been around since before the Civil War, which against public companies is unbelievable how long they've been around. But when you think about it in terms of generations, that's only 4 or 5 or maybe 6 generations of people, if you extend to people who are near 100 now that bought a policy 80 years ago. So it gives you a different, and it speaks back to one of Nelson's 5 rules: think long term. I think the mutual companies think long term. They practice what they preach. The public companies do get into new innovations and do get into things that are happening around them in the current environment. And so you just have a tendency to start to behave differently given your corporate structure.
Yeah, absolutely. Now, if you go back in history, life insurance used to be a place where there was a lot of money stored. It was a storage of wealth over the years. And obviously things evolved just like any other industry evolved. And you hear enough sort of opinions from some of the talking heads in the finance space, and you might hear from a neighbor, right? There's a lot of negativity around life insurance, depending on where people have experienced and what they've learned. And so, this is it's one of those areas that now we're going to spend a little time here just talking through some of the different varieties, because we obviously are proponents of the whole life insurance option as a permanent policy, but there are other ones out there. Started with the universal life, and now it's migrated to variable universal life that has a piece of the stock market tied to it. And then, more of the latest one, the index universal life. So, Chris, you want to share a little bit more about some of your thoughts on some of these other products and why they might not be the best suited for IBC?
Yeah, for sure. Well, I guess we should start with the denomination of these structures, and the denomination in the United States, at least, is the US dollar. So, from the 1800s all the way through, by some measures, 1933, by other measures, 1971, the dollar, although there were booms and busts around asset markets, the dollar itself and its purchasing power was, if anything, growing. In other words, you could buy more things with less dollars over that full century and a half, from the early 1800s all the way through the mid 1900s. And since the advent of gold's removal as a balance with dollars, again in 1933 under Roosevelt, and then really the final nail in the coffin of gold in 1971 with Richard Nixon, is holding dollars for a long time, can depreciate your ability to spend money on things. So that's the first area to be aware of, that just holding your insurance policy from 1880 to 1930 allowed you to essentially maintain or even grow your ability to spend in your later years, in your retirement years. That dollar was able to buy more goods, services, products, experiences. And in the modern day and age, that's not the case. And I think that's why people are very concerned with holding dollars for too long without having them employed in something else. And that's where I think a lot of these newer structures come from. Now, at the same time, we do have 12, 13 trillion dollars in bank accounts, but how that actually cycles and circulates between owners is probably a much bigger and longer conversation. But there is cash sitting for a long time in bank accounts. But back to the different products, I think the three you mentioned, universal life, variable universal life, and now index universal life, all attach themselves to some degree with Wall Street type products like bonds. Universal life attach themselves to fixed rate bonds. And during the 40 years where bond rates were dropping and bond prices were going up and up from 1980 to 2020, that was a valuable place to grow wealth beyond the value, purchasing power of the cash. And then maybe you could cover the other two.
Yeah, and variable, certainly with the rise of the stock market becoming much more prevalent in most people's lives, and time with 401k, all that evolution. Certainly, that's where a lot of the variable life started gaining steam. That you can have a piece of the, have your cash growing not into a bond account or something, but something tied to the market, right? And then IUL, which is more of an index, gets a little bit more involved with options, but allow you to take the upside of the market, a piece of it, and prevent downside. So this, again, when you compare a lot of these products, that the sort of underlying basis of them is a kind of growing term insurance policy that gets more expensive every year, and your cash gets thrown into a risk world, right? So we've added more risk to this type of policy that was meant to actually be a risk mitigation tool, right? So it was meant to protect, but now we're adding some substantial risk to it, to these sort of products to try to gain some more return. So really, it's that's why I think from Nelson's perspective, like those are not suited for IBC, because we're trying to establish a strong foundation with substantial guarantees and reliability to be the foundation of our financial world, right? And our ability to finance investments outside, not inside the policy. And these sort of these type of designs have actually shifted more of the risk to the policy owners.
Absolutely. Really, really great points. A couple of great things to unpack there, Tom. I think, the move that happened around the same time, the early 70s, from pensions, where corporations would basically reward their long-term employees with a lifelong pension after retirement. The move from there to 401ks was really a risk transfer, where the company said, hey, we want you to take the risk of your retirement, and we want to not have that risk anymore. Now, part of it was related to people moving around to different jobs. There was more of a movement to the workforce over time. Part of it was these pension funds were big and prone to trouble, either from the corporation itself or from the markets that they were investing in, that they were very, very happy to move the risk over to each individual employee, whether that employee was really ready to manage their own retirement fund. They did it. And I think in life insurance, you had that same sort of movement from whole life, where basically the growth of the asset was up to the insurance company to do its best over their long range goals and investments to do, into, hey, we'll cover the death benefit, or at least the difference between the cash value and the death benefit. You decide what you want to do with your cash value, invested into mutual funds or international stocks or index returns each year subject to a cap and a floor, or bond returns. And all of a sudden, you've got a whole populace who maybe is not fully equipped to understand all those different products and the risks and the fees associated with them, now involved in that as well, which is, again, a protection of your spouse and your family, and also a retirement plan that you have to be very, very careful about. And that was a great point, Tom, you made about the death benefit charges increasing. So with whole life insurance, you're quoted a single premium that stays the same for your entire life, knowing that your chance of passing becomes greater and greater with each passing year. With the other three products we mentioned, universal, variable universal, and finally index universal life, each year the charge on their risk between the cash value, which is essentially an asset that's owned by you, and the death benefit, which is a number many times much higher than that is going to have an increased premium charge each and every year based on your escalating age. So a combination of a down market and a turn from age 70 to 71, where that differential pops by 10 or 12 or 15% cost increase, a lot of people get very nervous about being able to maintain such a policy.
Yeah, and that's why it's so important for people just to recognize what they're getting into and for what purpose, right? There's not to say that there is potentially a place for these types of other permanent policies, but for the purpose of establishing your own sort of banking function and having that solid footing, it just isn't a great match from our perspective. And it adds more risk to something that's actually supposed to reduce it, right? Eliminate where your investments are going is where your risk is going to be. And hopefully we can reduce that by, investing in things you understand. But the last place we want to put it is in the place we're storing our wealth that is liquid and safe. So that's the difference in terms of why we advocate for whole life,
exactly.
For IBC.
And I do have clients that as of yet haven't been active users of their cash value. The reason they like whole life above the other ones is they like to look at that as the low risk, fixed income part of their portfolio, or even cash with an enhanced yearly return, at least to try to keep up with the inflation rate over time. But what we really love about it as well is if you get a big enough amount as a percent of your net worth in your whole life cash value, you can actually use that to take some risk, or at least use that as collateral to borrow cash from the insurance company to take some risk in areas that you really are excited about, perhaps know people who are quite skilled in it, as we've talked about, like real estate, like a business venture, like different areas where you can find opportunity and make nice returns off of it. So we're not going away from risk, but we're just kind of positioning it the way we see in the proper places.
Yeah, absolutely. So outside of just the risk aspect of it, the one other area that we know impacts our financial lives pretty greatly are taxes. And we've talked a little bit about it in prior episodes around some of the tax benefits of permanent whole life insurance policies, as it's certainly a great place to store wealth. But the tax benefits are still something you should be aware of, and some of the history behind it, started back in like the mid '80s, and when there were some tax reforms being led by Ronald Reagan, and eliminating some tax shelters related to real estate, and then we had some of the market crash right in '87, and so there was a tremendous amount of money being put into life insurance policies, essentially acting kind of like a tax shelter, right? You can put some large like lump sums in there, let it grow tax deferred. You should borrow, you can use it and borrow against it. So it led to some additional tax reforms later in 1988 or so that put some more restrictions on being able to put these one lump sums in and still maintain a lot of the tax benefits. And that's where we get into the idea of the modified endowment contracts, right? For those who are trying to benefit from some of these tax rules, not getting into that modified endowment contract is key, right? There might be a reason for it, right? There are certain purposes, but for the use of our policies for IBC, you want to avoid that. And then they start acting like a qualified plan, right? Where you're going to get taxed on the use of those dollars. And that's obviously not where the place we want to be. So it's something just to be aware of. The tax benefits are still a part of life insurance. You just got to understand how the rules are designed to put some restrictions on how much you can put into the policies. And that's why, again, working with an advisor who really understands the details of this are so important, because you don't obviously want it to turn into a modified endowment contract unless it's by design, right? But for most people that are trying to implement IBC, it's not where they want to go. So, Chris, anything you want to add to what I shared there?
Yeah, I think the move in the 80s was definitely, and here we are again, looking at the banking system and looking at the mutual life insurance company system and framework and models for running those two different types of businesses. In the 80s, the banking system got involved because of lightening of regulation into all sorts of dangerous assets, speculative real estate, even equity type participations in things. And they desperately wanted to earn more, make more for management, but they really didn't do much to keep the depositor involved in the returns that they were seeking. In that deposit rates stayed very low, especially given where treasury bill rates were deep in the double digits at that point in time. And insurance companies, the mutual insurance companies, they had these very high rates in their asset portfolio. And just the way it's structured in the insurance industry is they would share those dividends with their mutual life policyholders. So all of a sudden, word got out that if you owned whole life insurance, you were getting high single digit tax-free type returns. And with bank deposits, you were getting low single digit. If I said high double digit, I meant high single digit returns on your insurance company dividends, low single digit returns on your bank accounts. And so there was a huge move, and you were able to put lump sum into your insurance policy. And it was a tax-free growth, tax deferred and tax-free in death. So a huge amount of people, especially among the wealthy, the word got out to give up their bank account deposits and put their money into life insurance. And it was really against that backdrop of massive drains. And of course, the banks had all this risk that they'd taken on with their assets, and all of a sudden they were having all their liabilities, their deposits, drained out of the system. And this caused some very, very serious banking crisis in the early to mid 80s. And Reagan responded by creating regulation around the insurance companies to not allow for money or capital to move as quickly, deposit money to be withdrawn and immediately moved into insurance companies, but rather only over time. So all of a sudden you weren't able to lump sum it as they used to say in the 80s, but you would have to put your money in over time. The benefits, the tax benefits, and the sharing of wealth is still there. And so to us, I think, Tom, the real beauty and value of whole life insurance didn't change dramatically. Just the rate at which you could move it from the bank deposit to the life policy got slower and got regulated. So as that deposit, where you might have been able to put 100 grand in there, and the lifetime death benefit drops its cash value to 90 grand, that moment in the newer type policies, even with IBC, it's 10 grand a year for 10 years. And that first couple of 10 grands are only worth 3 or 4 or 5 grand. And therefore, it just feels not as good in those early years. And that's why we do a lot of educating around why the long view is the right way to think about it.
Right. And just be mindful, right? So it can get complicated, but that's, again, it's thinking long term and getting around advisors who are going to share the truth of it, right? And recognize the early challenges with it and prepare properly for it, and recognizing where it looks long term. So that's all I think we want to cover in this episode, just giving you a kind of a broad strokes around the life insurance industry itself, and kind of where we are with things around, the types out there and the taxes. And the next episode, we're going to go into something that I think a lot of people have adopted, a philosophy of this concept of buy term and invest the difference. Sounds easy, sounds to make a lot of sense. And we're going to go through that a little bit more detail and share the truth about it. And then you can decide for yourself. So Chris, thanks for joining me on this episode. We'll definitely see you on the next one.
Thanks for having me, Tom. I'm really looking forward to that next one. I love that term and breaking it down for what it really means.
Thanks for listening to this podcast, and hope you're enjoying this series on the infinite banking concept. Next up is part 6. Isn't it better to buy term and invest the difference? In addition to the podcast, I would highly encourage you to get the book, Becoming Your Own Banker by R. Nelson Nash. If you want to discuss how IBC can enhance your financial life, feel free to book a free call with our team. We'd be more than happy to help. Visit perennialpride.com